Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is David McIlwaine. David is a seasoned entrepreneur, a successful executive with deep experience in business growth, scale, and delivering results. His real estate experience is vast and spans over 20 years. His experience, his knowledge, and his understanding have been gained firsthand by owning multifamily units, commercial retail developments, asset management, single family, vacation rental properties, second homes, and even custom builds. He wore golden handcuffs for almost 14 years, successfully gaining sovereignty over his career and his net worth along the way. He founded Mac Assets in 2019, and they currently have over 1,000 doors. So, David, welcome to the show.
Thanks for having me, Keith. It's wonderful to be here.
Yeah. I'd like to hear just a little bit about your background. And I always start with, kind of where you grew up and what got you into real estate. And it sounds like you took a professional career before getting into real estate. So just want to see how you made that transition.
There's a stat somewhere that I read at one point in my career that said the average person has 5 careers in their lifetime. And it's a lie that people don't understand that you have just one career. That's the lie.
Yeah.
Most of us have multiple careers. And the reality is that doing the same thing for 40, 50 years doesn't work for a lot of us. And so I'm no exception to the rule. I've had multiple careers. So my core education is in advertising, and I spent 20 plus years in advertising. And while I was there, I also did a lot of work in real estate on the side. So I used to be both an advertising buyer, and then I was an advertising seller, and then I was an advertising sales executive. So I got into real estate after I experienced another one of the lies that no one's ever going to get laid off that doesn't deserve it.
Right.
There's a reality that hits us that in the course of 18 months, I went through 2 layoffs that were not relevant to performance. The first one, I had been at the job for 17 years, and I had hit quota. Starting the quarter prior to the beginning of the quarter, the quota was measured against. So I walked into every quarter for, I think it was 7 or 9 quarters in a row, already at budget.
Wow.
And literally the day I got laid off, I made the budget for the next quarter. So it wasn't a performance issue. It was a merger, and they decided that everybody at the executive level I was at was gone.
Wow.
So I laid off. My boss laid me off, and the next day he was laid off. So fast forward 18 months later, I am a chief revenue officer for a tech startup. We go through a Series B round of funding. I come in ready to hire 35 sales reps to extend the sales team. The CEO says, "Hey, we paid off our debt." And I said, "What debt?" And the 35 sales reps went to a sales rep plan of 5. I came in the following week and I was told, "You're being laid off. We're not going to have a sales force."
Wow. That's crazy.
So what brought me to real estate was this lie that we never lose our jobs because of performance. it's not if you're going to lose your job, it's when and how. And that's part of my message to everybody today is to understand that your job is not a forever.
Yeah.
And post that layoff in the tech world, I was going through a bad divorce and I couldn't travel anymore. And I became a single parent. So I jumped into real estate. And it's been an exciting roller coaster ever since.
Wow, that's interesting. Let me ask you a few more questions about just the advertising. So, what type
Fire
of
away.
what type of products were from an advertising standpoint were you targeting? Was there a specific vertical, or what did that look like?
So it's interesting. I sold radio and television on a local, regional, and national basis, either direct to a marketer or via an ad agency, or um, and I would also sell an unwired network. So my product was traffic reports on the radio.
Hmm.
And if you hear a traffic report on the radio, somebody puts it together. Somebody then disseminates that information, and they don't have 35 traffic helicopters flying in the air. They don't even have 5. They often don't have any. And when I was working here, we used to have 2 or 3 at a time. And we would disseminate that information to radio and TV stations and the internet. And in exchange for giving them that information, we would have inventory to sell. So I was responsible for selling that inventory across the country and for monetizing it on the internet as well.
Wow, that's interesting. Yeah. So, and I agree with you as far as the lessons. I've seen that even in my own life. My dad was in the tech industry, and years, probably about 10 years, maybe 15 years before he would have retired anyway. He got laid off and just had to reinvent himself for that remaining amount of time. And so,
Mm-hmm.
I have a saying with the wealth flow, and that is, that you want to put yourself in a position that you're job optional, right? So if something happens, you can sleep better at night. You don't have to be so dependent on that W-2 position. So,
Yeah, and I think job optional is a great way to put it. I view it as sovereignty over your career and agency over your life.
yeah, I like that way too. That's a good way of putting it. So tell me about how you when you got into real estate, what type of real estate did you kind of get your feet wet with?
Well, I was going to be a flipper, and I got into flip single family homes. And I quickly realized, and this is about a decade ago, I quickly realized that flipping was not going to provide me the best return on my money.
Hmm.
So I became a realtor instead. And the reason for that was that I was going to put anywhere from $100 to $300,000, maybe $500,000 at risk for anywhere from 30 to 50 grand in profit
Right.
pre-tax.
Hmm.
The math on this did not excite me.
Yeah.
My risk was going to be 3 to 500K. My reward was going to be 10% of that risk. And somehow that balance didn't feel right. Now, I could have taken the leverage factor into equation,
Yeah.
but the cost was there as well. And the debt service was there. And even when all that was said and done, the risk was still at the best case, still going to be 6 figures.
For sure.
And so
Yeah.
at best, I was going to get a 50% return over the course of 6 to 18 months, depending on a ton of variables that I did not have control over. So I quickly realized that selling real estate was a highest and best use for my skill set. I did that for several years, and I started building my own portfolio. And from there, one day I was at an investor conference and I heard somebody talking about multifamily. And I sat down because the guy had his W-2 up on the screen. I'm sorry, not his W-2, his K-1.
Hmm.
He had his K-1 up, and that obviously is a partnership tax return, and it had a negative $444,000. And he was bragging about losing $500,000. And I said, okay, what's this about? Because generally when you lose $500,000, you don't brag.
Right.
And he sat down and he said, it's an offset of ordinary income. And my eyeballs went out of my head. And as a previously highly compensated employee, to offset ordinary income is the golden goose of tax strategy,
Yeah, for sure.
right? And he then said, if I'm going to buy one apartment, I can buy 100.
Hmm.
And I owned doors at the time. And my previous job as a sales executive was to sell 1, 5, 10, 15, 100, 214 cities at a time. And I had made my bones and was highly successful selling somewhere between 30 and 70 cities at a time.
Yeah.
And what I knew was it was a little bit more work for one or two more zeros. The process was the same. The starting point was the same, but the end result was very, very different. Now, there's a scale of complexity in this. And I was on a Joe Fairless episode, and he was like, no, it's not right. It's not right. It's not right. And I'm like, well, yeah, it is. The job is the same. You're buying doors. Just a matter of whether you're buying 1 or 100. You're buying insurance. You're doing risk mitigation. You are doing all the same things. So in that minute where he said that to me, and I realized the scale was the difference, and that I had had a tremendously strong background in changing scale,
Mm-hmm.
I jumped in.
That's great. Did you jump in to invest in somebody else's deal as a passive investor, or did you just jump right into actually actively a general partner type?
I did a little bit of passive. I did a little bit of passive in the beginning, but I quickly realized that passive was not who I am.
Yeah. Yeah.
And I had a lot of background building teams, leading companies. I had the real estate knowledge that a lot of investors don't have, having been a licensed agent for many years and owning a residential brokerage at the time. So I did a passive one. I had also been in passive investors when I was selling advertising. I'd been a passive investor before.
Hmm.
You know, the Jobs Act of 2016 started creating, the Jobs Act of 2014 started creating 2012, I'll get it right, 2012, passed in April of 12. The Jobs Act of 12 created a greater arena to syndicate real estate. But I had been in syndications that were definitely 506Bs prior to that, earlier in my career as a highly compensated employee. And I was trying to find ways to invest outside of the real estate market. Outside of the stock market.
Okay.
And so I knew a lot about this, having had that life. So I got into one passive one, and then I said, hey, wait a second. I watched it soup to nuts, and there was minimal difference from what the sponsors were doing. And I quite frankly thought their skill set was pretty weak.
Okay.
And so I started looking around, and I quickly became a general partner.
That's great. Did you do any kind of, I just know a ton of folks that have gone the, route of signing up for a course or having some type of a mentor. Did you have any of that, or you just kind of jumped into it?
Yeah, I did some mentor work as well,
Okay.
because, you don't know what you don't know.
Right.
And you do know what you do know. And one of the things you do know if you've been a business professional for a long time is systems,
Yeah.
processes, how to read a room, how to negotiate a contract, what someone's really meaning when they talk to you about a sales event. And I think that's a lot of the stuff that people don't talk about. The tenants, toilets, and termites is product operations.
Mm-hmm.
And we hire for that.
Right.
And as an operator or an investor, what I look for is the leadership and the knowledge to be able to handle the problems that arise, because they will arise.
Yeah.
And the question is not what data point it's how are you going to lead through the problem and find creative problem solving or strong and sound strategic problem solving to keep the project on one point.
Yeah, for sure. What, as far as your initial investment, and then maybe where you invest now, what is there a specific geographic area, or what are your where do you focus?
Well, I started like everybody else in the Southeast, and I've had mediocre results in the Southeast. And I think there's a couple of reasons for that. One, I was a little late to the party. And two, there's a lot of competition that was artificially decreasing cap rates and increasing price.
Right.
And I think there was too much demand. I morphed into the Midwest more in the Kansas areas and Kansas City, and I like that market for a lot of reasons. And I've been there for 2.5 years now. And the reason for that is that I went to KU, and KU is 30 miles from Kansas City, and I know it.
Right.
And B, it's a test market. People don't realize this, but Kansas City has been a test market for consumer packaged goods and any kind of product launch for the last 35, 40 years.
Hmm.
And what that means is that it is a bellwether industry market. So if it survives in Kansas City, it will survive on the coasts.
Right.
It also means that Kansas City is a rationally priced market. And it's not huge such that the demand is going to outstrip the supply. It's starting to change a little bit. Like, there's a lot of growth there.
Mm-hmm.
And they've done some really good infrastructure projects. The airport, the center, the trolley system. It's not called a trolley, though. It's a train. And they're really revitalizing some of the urban core. And that's a great thing. Plus, you've got this, it's geographically centered. And with the airport coming online and really changing the way that they access air travel, I moved to Denver when our old airport was closed and the new airport was opened in 94.
Okay.
And I watched what happened when the airports changed. And when you can land bigger planes, and one of my clients I used to work for United Airlines as a media buyer, and I used to sell for Frontier Airlines. I used to vend to Alaska Airlines. And so and my dad worked for American. So I've kind of been on the tertiary of the airline industry for a while.
Yeah.
And I know that as flight access changes and improves, cities grow.
Yeah, that's very true. Yep. I'm seeing that happening right now with San Antonio. That's where I live, San Antonio, Texas. So
Oh, very much so. And that airport has been a sleeper airport for a long time.
it has. Kind of enjoyed it because I
And
travel quite a bit for work and flying out of there. It's, not like most where I don't have to get there super ahead of time. And it's just a little bit from my house, but yeah, it's gotten busier and, but it's also there, it's growing, so.
Right.
Yeah, for sure.
So that's kind of how I got into the Midwest. And I've been looking in Colorado for 2.5 years and haven't found the right property yet because I think that the marketplace is overpriced.
Yeah, I could see that with Colorado. It sure is beautiful up there, though.
Well, thank you.
Yeah.
I created it,
Did you? Oh, okay. Perfect.
Yeah. Me and God together.
Right.
Maybe I sat back and watched when the mountains were built and, the tectonic shifts in the planets and everything. Yeah.
Exactly. And what? So on that first one that you were the general partner on, maybe how many units or what does your current buy box look like?
So my current buy box is really kind of evolving because of the Fed.
Okay.
What I see is that the Fed has gone through a once in literally almost 2 generations skyrocketed hike, right?
For sure.
We've had the highest change, the most aggressively in 40 years. So a generation is 25 years. So it's damn near 2 generations since we've had this pain before. The Fed's going to start falling off in a little bit, but right now the cost of funds is so high relative to the cap rates. The last time the Fed did this, the cap rates were in double digits.
Mm-hmm.
And if the cap rates were in 10s to 14s, you could still produce profit by paying for that. But now that the cap rates are in the 6s, 5s, 4s, 7 range, you're doing negative leverage.
Yeah.
And negative leverage, you can make money in negative leverage, but the risk increases.
Right.
And the operational requirements for performance accelerate. So I've been looking for some 50/50 LTC, LTV purchases that are in the 50 to 100 box size. I think that a lot of the stress of the debt is going to show up. But the reality is that stress and the debt that's going to show up in the next couple of years is a small portion of the market.
Right.
And right now the market's kind of seized. So the guys that are selling are either super distressed or they finish their business plan, which are the rare birds, or they're still trying to unrealistically garner profit from the market that the market has said no to, and they haven't caught up with the realities of the marketplace. So in the 50 to 100 unit box, it's a little easier to raise capital. And what my experience is that contrary to the smart thinking, most private investors, most individual retail investors have gotten scared.
Yeah. I can
And if
see
you
that.
think about it, that's the worst thing you could do. What would it have been like if you could have bought all of your real estate in 2008?
Right. Yeah, exactly. It would have been wonderful. Yeah.
Why?
Just because it's gonna go up first. You got to wait for the pain a little bit first to be able to get it at a lower price, but then all of a sudden, things will turn around again, just like they did in the past.
Yeah.
Yeah,
So if you buy in '08, you're buying on the down,
yeah,
right? But you don't know this, but you're going to run into the largest bull market that we've ever seen if you buy in '08.
that's right. Yeah, yeah, for sure.
Fascinating. Are we in the same window today? I believe that we're pretty close to it. I was looking at the Chatham forward 10-year forward curves and the SOFR rates forward 10 years yesterday because I was working on an underwriting project. And, they're saying it's going to level out somewhere in the 5, 4.5, 5 basis, and then it'll drop down again and again, and it'll get back to the 2.5, 3 basis.
Hmm.
Now think about that. We're at the same point we were at in mid 2008. And yet everybody's petrified, just like they were in 2008.
Yeah,
It's really hard to be a contrarian, and that's where the money's being made. So if you're an individual investor and you think about this, call me. Let's talk about it. Because what we see is that there's going to be some more pain.
for sure.
We don't quite know how bad the pain's going to get, but we do know that the pain is very different. And every time we go through a great recession, and I use the word great loosely because the 2008 Great Recession was, from my experience, no different than the 92 recession I lived through, where there were no jobs. And if you don't have a job and you're unemployed, it's a great recession.
For sure. Yeah.
If you have a job, it's not that big a deal.
Right.
And economies are localized and personalized, right?
Mm-hmm.
So if your business is underperforming right now, the world's falling. If your business is performing just fine, you don't get it. And that's the way it is everywhere. And so I think that's a core part of this, is to be able to dispassionately look at the math and then follow your trusted gut.
Yeah, for sure. And I think there's opportunity. Even I'm sure you've probably heard as well as I have. Kind of the phrase "the Red October." It's starting to come out where they're saying, here in October is when we're really going to start to see these large commercial loans that they've got. They're coming due, and they're going to have to do something. And refinance is not necessarily an option because the rate's going to go up so much. So there's going to be some opportunity out there for sure. And that won't just be in October. It's just supposed to start real heavy in October, and it's going to carry.
But let's talk this through for a second.
Yeah.
If it started in October, the typical commercial note is how long in duration?
Usually about 5 years.
Right. 5, 10-year AM, 5, 10-year sec, somewhere between 5, 7, 10 years is typical commercial, right?
Right.
And then there's typical IO of 1 to 24 months on there. And then if you're doing a bridge debt, a lot of this is about bridge debt, right?
For sure. Mm-hmm.
And the bridge debt, and I assume you're talking multifamily, or are you talking all commercial?
I would say multifamily.
Okay. So if we're talking about multifamily, then I saw Neil Balwa talk about this and I was fascinated, and he was absolutely right. The percentage of multifamily that are on notes right now is about 15% that are in that window of, we can see a risk on the horizon,
Mm-hmm.
which means that 85% of them are fine.
Right.
Now, when you think about the marketplace, 15% is a lot of pain.
It is.
It is. Yet, 85% of the market's stable.
Right.
Now let's process that together. What does that really mean? That means that some individuals are going to have really ugly results.
For sure. Yeah.
But 8 out of 10 won't.
Right. Yeah. True.
And if 8 out of 10 people aren't going to have ugly results, why does everybody sit on the sidelines?
Yeah. Good question.
How do we know when we're at the bottom?
It's very hard to time the bottom, exactly the bottom, right? But
Yeah, it's impossible.
yeah. So
So then how do we know when we're at the top?
yeah, we don't clearly.
Right. And as I think about this, I, I keep processing back to the concept of a series versus an event.
Mhm.
And investing is a combination of events that make up a series, right?
Yeah,
So if I talk about, I have a portfolio of 1,000 units, and if I talk about one of those doors, it's 1/1000th of my portfolio.
right. Yeah,
And as I think about it, one investment is one decision I'm going to make over my investing career. And my goal is to beat more than 500.
right.
And people forget the goal is not to get to perfect.
For sure. For sure. I mean, it's always
And
better
they hate,
to take action, versus sit on the sidelines. Yeah.
yeah, and they hate the idea of losing money, but we're going to lose money sometimes.
Yeah.
It's inevitable because no matter what we do as investors, there is risk. And at some points, that big capital R shows up and that risk wins. So, yeah, I think this is a rational thought process of, can you get to investing correctly 5, 7 out of 10 times? You're doing pretty good. If you double your money 5 times and you lose your principal 1 time, that's not a bad risk.
Yeah, for sure.
So long as you keep placing the same size bet. If you put all those 5 doubles into one investment and you lose that one, you kind of went all in
Mhm.
and on one poker hand. And who among us goes all in on one poker hand?
Right.
You always got to be able to rebuy.
That's right. That's right. Exactly.
And I'm not a poker player. I can't. My eyes are so bad I can't see the cards quick enough to process. I got to look at them 3 times, and by then I've shown somebody my cards at the table. So I don't play poker.
Yeah, I used to play a little bit, but don't play either. Just to me, it's the time commitment of just sitting there. I just
Hmm.
have a hard time sitting there that long and really be involved. So
And I'm not a gambler. I'm an investor,
yeah,
and there's a big difference. I take mathematically calculated risks.
that's right. Yeah, exactly. And so
I'm sorry, I got off on a tangent. I apologize,
that
but I think you were asking me something entirely unrelated to where I went.
That's okay. That's okay. And so, what are you seeing then? Obviously, neither one of us have a crystal ball, but what do you anticipate is going to happen with rates over the next year? When do things start to get a little bit more in line? I know I'm throwing a lot out here, but also cap rates.
Yeah.
When do those expand a little bit? I mean, there's going to be some type of an adjustment there where things hopefully will be priced a little bit more sensible.
Well, I go back to something I learned a long time ago. I used to work for a billionaire, and he taught us a couple of things. And one of them was motivation, motivation, motivation.
Hmm.
And as I was a young kid at 24, 26 years old working for this guy, I thought he was full of crap. But the more I look at it, he's absolutely right. So I look at the motivations. One, let's look at supply and demand of housing. Our new housing starts are not sufficient to meet our demand nationwide.
Right.
And that math changes market to market. However, most markets are undersupplied in housing product right now. There are a couple that are oversupplied, and there are some demographic shifts involving that. But generally speaking, the demand for housing is at historical highs. Our population's at historical highs. The millennials are now at a demographic shift where they're reproducing, which means the baby boomers are starting to die and millennials are starting to reproduce. And those are the two largest generations out there. So they're buying homes, they're reproducing. This is an event. You've got the seniors trying to age, living longer, which means we have a greater demand for senior housing than we ever have before because their lifespan has increased, even though COVID reduced their lifespan by 2 years.
Hmm.
So as we look at this supply demand problem, we have a supply problem. That's item one. Item two, you've got sellers and investors that are both demanding returns that are not rational to the current situation. And that has seized the market because people like yourself and myself who work in this market day in, day out, working in the housing stock, know that I can't make a return based on the current cost of money if I overpay for the asset. And the money is always made on the purchase.
Right.
And the seller who's forced to sell is avoiding selling at any kind of detriment to their financials because they don't want to respond to investors or their own lost expectations. So they're sitting on the sidelines. Thus, your concern about your commentary of Red October.
Mm-hmm.
And Red October, I think, will be a pressure point, but it's no different than it was in July or no different than it is in January. It's just a matter of the calendar coming to bear and what's happening. And that's 18 months or 20, that's 30 months post when the Fed started raising rates in March.
Yeah,
right?
for sure.
If you really look at it. So a whole cycle of debt has come due. And that's the thought process behind that. Then from there, you also have, so you got this demand pressure, you got this banking pressure, and you got a pressure from the seller. Who gives first? The seller's going to have to capitulate, and the buy-sell spread has not gotten there. But as long as a seller can hold off, they will. And out of that 15%, if half of them can recapitalize or restructure, they will.
Yeah.
Which means you go to 7.5%. Now, out of that 7.5%, how much of that inventory is crap that no one wants that was bought by excessive exuberance? Half of that?
Yeah, probably.
Okay. So bye-bye, guys. You made a bad decision. And then the other half is where the real pain shows up. And then, of course, you have the bad actors like, and it's hard to say someone's a bad actor just from a headline. So when we look at all this together, we see that I think we're going to have a different outcome than people forecast. Where's our unemployment?
Yeah, it's not bad at all at the moment.
It doesn't exist.
Yeah.
We have been at full employment for, gosh, I want to say since like 2010, 2012. Full employment's defined as everyone has a job that is capable of having a job and wants a job.
Mm-hmm.
And typically the number's been 4% unemployment nationwide. That's a historical average. Now it's somewhere in the twos in most places. Sometimes it's a little higher. It's industry specific. So you've got some retraining going on. So I do kind of think the Fed might actually get a soft landing.
Okay.
Which is crazy.
Yeah.
Now they overprinted money, but they had to. If they didn't overprint money, and this might be a little counterintuitive, if they hadn't overprinted money during COVID, what would have happened?
Yeah, if they hadn't, then we would have seen a lot of these economic problems sooner, I think, than what we what we did.
Well, let's go back to September 11th, 2001. The stock market was shut down for a week. There was no air travel for a week. I don't know if you recall that or not, but I was an adult, and we were actually, when I was working with the traffic company, we had F-16s escort our traffic helicopter to the ground in multiple cities, and they said if they didn't land in 3 minutes, they're going to get shot down.
Oh wow!
So a lot of this has been burned in my brain, and I remember watching everything fall, and the economy for a week was just stagnant. That was the moment when the Fed dropped rates to zero. And it was the first time they had done it since the Depression. So to get from 0 to 22 years later is what's really happened. It's taken us 22 years to cover that spread back. So imagine being out of work for the economy shut down for 8 to 12 weeks with no stimulus coming in.
Yeah.
It took us 22 years to get back to a normalized fund of funds rate.
Very interesting. Yeah.
Yeah, people don't think about that like that. But when I look at the calamities, and you can go back further, but what the Fed's done now is they wanted to slow borrowing. And they did. They seized the markets. The residential real estate market, people that are selling so because of, I heard it today, the 5 Ds: death, divorce, debt, diapers, and degrees.
Yeah.
In other words, they have to sell because a life situation has forced a change in their world. And that's what's happening here as well.
Very good.
So what does this mean for the investors, right? That's what we really want to get to is what does this mean for the investors? I think it means you keep playing the odds, and the odds are you can't win if you're not in the game.
Yeah. I agree.
You got to make smart decisions, and you've got to be able to figure out what your goals are. But fear has no place in this decision making.
For sure.
In fact, I think that this is very similar to 2008. If I'd been able to buy in 2008 and sit on it 4 years, what would have happened?
Yeah, you would have made a ton
If
of
I
money.
bought it in 2008, if I bought it in 2008 and was selling it in 2023, I'll tell you what would have happened. I looked at this today. I'm looking at buying a small little deal in Denver in the suburbs. And they bought it in 2008 for $600,000. It's listed for 2.2.
Wow. Yeah.
Okay, so that's a 3x multiple plus. It's actually almost a 3.5 multiple in 20 years. It's not great, but it's pretty good.
Yeah. Yeah. It's not bad at all.
No one would complain about that.
Right. And if that's just one of the deals that you're doing along the way, because you're active, because you're involved and you're in the game, then that's just going to be one of many that you're going to see that kind of lift on. So,
right. And it goes back to series and events. The job is to get 6 right and 3 wrong, or 6 right and 4 wrong.
yeah.
And make sure the 6 you get right, you don't all put on the same bet every time.
Exactly. Yeah, no, good point.
Which goes to diversification. I can go to diversification from there if you want to, but you know.
Yeah, let's talk a little bit about diversification, because I noticed in your bio you talked about a little bit about stock market as well as investing in alternative assets. You want to maybe speak to that just a little bit and why you think that's so important?
Yeah, think about this. Let's ask ourselves some questions. How many people are in the stock market now versus in the stock market 50 years ago? The number's massively different. I don't have the exact stat, but what's the difference and why did so many more people invest in the stock market in 2023 than in 1970? It's a really simple answer.
Yeah, it's your retirement plans, your 401k, and that's
exactly
gets everybody in. It's kind of the shoe in.
And that wasn't there before.
Right.
So before the 401k was created and pensions were destroyed, the stock market was a gambling place of the wealthy, and now it's become America's bank for retirement. The problem with this is that people are trusting the stock market because they trust the professionals to give them the best advice they can, when the reality is the professionals are giving them formulaic advice. And the formulas are all they work with. And I think that stock market's important to be in. I own individual equities. I own tracking stock equities. I own a couple mutual funds, I think. Actually, no, I don't. They're all tracking stock equities now, and they're all tracking index funds. So there's no reason to put all your eggs into a basket. I heard a stat earlier today that something like 7 out of 10 Americans don't have a financial plan. And as we think about this, they buy stocks and they pray. The reason you should buy stocks is because you're taking a bet on a segment of society. You can take a bet on large companies. You can take a bet on technology companies. You can take a bet on a company. And I use that word bet specifically because the reality is that we don't have insider knowledge, because by law, we can't have insider knowledge on what's happening in those organizations. So you're kind of saying that the past is going to repeat itself, or you're forward looking and you're taking the trust of Wall Street and you're taking the recommendations of Wall Street and thinking about them. It's a good place to make some considered bets. But at the same time, if you put all of your bets into just real estate, You're deciding that your entire financial liberty is predicated on one performance.
Mm-hmm.
And I don't know about you, but I don't own one pair of shoes.
Right. Yeah.
I don't fly on just one airline. I don't eat the same chicken every night. There's a law of averages. And so if you think about the law of averages and the discussion I made about series and events earlier, a series of investments will yield a macro result. And if we're all working toward a macro result of either financial freedom, sovereignty over your net worth, your thing was an optional job, I think was how you said it. I don't quite
Job
recall,
option.
Keith. I really like job optional. Yeah.
Yeah.
Or I want to be able to have steady cash coming in. You don't put everything on one decision. You know, that's analogous to deciding that you're going to walk into a casino, put your entire life's earnings, savings, and future on either red or black.
Exactly.
Who in their right mind does that? So if you're not in your right mind to do that, why would you in your right mind put everything into real estate? I believe that Apple's got a really good product. I'm gonna invest in some Apple business. I think their product is in demand. And like Warren Buffett says, I invest in things I know, like, and use. I use Apple. I know they've got a good product. I know that the consumer loves it. I also believe that Tesla's not the car for me. So I'm not buying Tesla stock.
Mm-hmm.
I think it's overpriced and devalued. I also know that, and this is my opinion, I'm not a professional stock analyst, and I have not paid by anybody. So there's enough disclaimers there. Don't trust me. I'm an idiot that was a wrestler in high school. So, inherently there's a problem with me. And as we think about it, we don't live our life doing one thing only. We spread it out. And I think investing is the same thing. You have to dollar cost average your decisions. So I'm going to dollar cost average some residential housing. Maybe that's my primary residence. Maybe it's a short-term rental. Maybe it is a long-term rental. Maybe it's a duplex. Then I'm going to add in there some growth stocks. Maybe I'm going to invest in the UK because I think they're going to grow, or I'm going to invest in Africa because I think they're going to do it. It's not a singular picture. Often the problem with financial literacy in this country is that we think about them in silos.
Yeah.
And my argument is never take everything out of the stock market. My argument is to grow each part of your garden well. And to follow that analogy, you harvest tomatoes during the summer, you harvest gourds and pumpkins in the fall, you change things and you harvest different things at different times a year. And that's the same with your finances. You have to look at this thing in a holistic, complete picture. So the stock market is a big element, but if your entire W-2 and your 401k and your investments are all based on the company that you work for,
Mm-hmm.
there's zero diversification. I remember when I was working in the media business, I had a highly compensated job. And I had a 401k that the company had, basically their matching payments were in stocks within my own company. So my income and my stock appreciation was in the same place. And then the 401k was 6 choices. Oh, so I had a whole lot of decision-making ability, right?
Right.
So I couldn't grow my net worth there. I had to grow it elsewhere because if the company faltered, and actually the statement is when the company falters, I lose.
Yeah.
I keep a check on my wall that's $2.85. It's the value of 17 years of stock options when the company merged.
No kidding. Cal.
Invest 17 years of stock options vested, mandatorily vested and sold at the close of the merger was $2.85.
Oh my gosh.
And so that's a great illustration of having your income, your 401k, and your stock portfolio all in the singular performance. Whether it's a company, a category, a market. That's why I don't want to buy in just one market. That's why I'm working on a condo development, redevelopment, reuse, adaptive reuse project in Tacoma, Washington. That's night and day from Seattle.
Yeah.
I'm sorry, from Kansas City. It's night and day. It's 2 time zones away because the economies are different. And you've got to diversify this. If you go all in and you're wrong, the consequences are tremendous.
Yeah, that's neat. So, yeah, let's talk maybe a little bit about that. What's tell us a little bit more about that project, and then I'd like to hear about some of the others that you've done, whether it be the vacation rentals, if you still actively have some of those. Yeah.
So we're doing a condo conversion in Tacoma. We're working right now with the seller. It's not completely disclosed. So I'm not going to tell you a whole bunch about it other than, if you look about supply and demand, like I said earlier, the supply for housing that's rationally priced is challenged. So in Tacoma, I think the average price is $1 million. In the SeaTac area, it's over $1 million the average home price.
Wow. Okay.
Yeah, totally different than Seattle. I'm sorry, totally different than San Antonio,
Yeah, for sure.
right?
Absolutely.
Denver, you know what the average price in Denver is? It's $600,000 right now in the Denver metro. It's 600 grand for a home.
Yeah. That's
So,
crazy.
and one of the things we're working on is how do we take office buildings that have a good set of bones and convert them into condos and a path to home ownership for people, not necessarily rentals. Not everything has to be a rental. And we can solve a problem here. We can take a building that's completely vacant and that is beautiful on the exterior and up to date and can change over the interior to a housing element. And it's going to be expensive, but we can sell a product there that instead of being $1 million is 800,000.
Mm-hmm.
So we're actually benefiting the community by drawing down the average cost of housing. Small draw, small change, but it still matters. So that's one of the things that we're looking at.
Okay.
Short-term rentals, I got out of it before Airbnb existed.
Oh, really?
I was
Okay.
doing them in the very beginning with VRBO, and I had properties in the mountains and on a beach. And I found it not to be the best thing at that time. I am a fan of them hypothetically. I am looking at it very closely as an investment thesis. I too host a podcast, and I've had a couple of short-term guys come on and talk to me, and they've changed my point of view.
Okay.
So I am exploring it. I'm in a market where we are very anti short-term rental because our whole business is tourism in the state of Colorado.
That's right.
And so when you put Airbnbs in there, it really affects the population, the tourist industry, which is one of the top 3 industries in the state, to the detriment because it takes money out of organizations that pay people and it takes away more housing. And it's a real problem in the tourist areas of Colorado. There are 3,500 or so permits in Summit County, which is where Brett, Keystone, A Basin are headquartered. And they won't issue anymore because that's 3,500 hotel rooms that have 3,500 lodging units that were for people to live in that are no longer there, and the cost of housing there for the worker is non-existent. So the workers are commuting an hour plus each way to serve the ski lifts, and the ski companies can't afford to bring in workers. So when you get to this chairlift and you got an hour and a half long wait, that's part of the reason why.
Yeah, makes sense.
And that's the domino effect that we don't often talk about. So in some places, I think it makes perfect sense. Some places it doesn't. I've done some commercial stuff, and I really like commercial strip mall stuff in certain places. Once again, it's geographic specific. Custom builds, I think, are a market I'm no longer going to try to serve because it's really high end, and I would rather bring more housing to more people.
Okay.
I think that we've got such a supply shortage that we need to be bringing on more housing units. And we've got a millennial generation that is far more into sharing than any generation we've had in the past. And as much as we can help condense and create some more density in the metros, it's probably for the better because it eliminates some of that suburban sprawl. And I, as much as I like my suburban sprawl inherently is not beneficial to us.
Yeah, for sure.
it creates greater cost for the economy.
Yeah, it makes a whole lot of sense. Hey, I've got a couple other questions for you, but where can people find out more about you, David?
Couple places. Number one, I host a podcast called Break Your Golden Handcuffs. And we talk there about financial literacy. We talk there about investing. We talk about all kinds of things. Second is my company is Mac Assets, MAC Assets.com. And you can track down all you want.
Awesome. Well, I've really enjoyed our time together. I've just got a couple more questions that I ask every guest, and that would be on what would you give somebody that maybe is just starting out as far as advice?
Read. Experiment, and accept that you're not going to know it, and it takes a village.
Yeah, I think that's all good advice. And then what about a book recommendation? Anything you read recently? I asked this for the audience, but I also ask it for myself.
We have all the same books going around the real estate investing world. So I try to find different ones to pull out.
Yeah.
I just found a copy of The Outliers again in my library from Malcolm Gladwell. Wrote it about 15 years ago, I think. And it's the book where he enumerated what it takes to be an expert. And it takes 10,000 hours in one field to become an expert, which is 5 years at 40 hours a week. And I think that the process he writes there about what it takes to be exceptional is still very much valid today. So let's put Gladwell on the list.
Yeah.
I am currently reading Donald Miller's book about story branding.
Yeah.
And I really am enjoying that. So there's two. Or if you go over my shoulder, Who Not How's the third. I like that one.
I like that
pretty
one
good
too.
one.
Yeah. I actually just read or listened to the Donald Miller one, just 2 books back. So yeah, very good. Well, David, I've enjoyed our time. I know we're running just a little bit long on time, so I'm going to kind of end it here. But thank you so much for being a guest on the Wealth Flow.
Hey, Keith, wonderful to be here. Thanks for having me.
Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.